In the last couple of videos, we learned about the first building block, which is our income statement or the money-making machine. In order for you to understand the business, now we need to consider the second building block, which is the balance sheet, or as we call it, the wealth creation engine. Now, the balance sheet is typically, when it's presented, is balanced on assets and liabilities. And reading the balance sheet, it really is quite complex, and it doesn't really serve us from a management perspective. It doesn't really give us any intuitive understanding of how we might make the business perform better, how we might create more wealth, how we might optimize that balance sheet. So I'm going to reconstruct the balance sheet for you, and I'm going to hinge it slightly differently. And I'm going to hinge it on funding and investments. So funding, in order for us to start or run a business, we need to go and get funds for our business to allow us to make investments, which will then allow us to make things, sell things, distribute things. Now, there are only two places you can go for funding, only two places you can go for that money. Number one is you can go borrow that money in the form of interest-bearing debt. It's what we know as other people's money. The other area is you can put your own money into the business, and that's called, has the fancy term of equity. And the combination of debt plus equity gives us our funding block. And that has to balance against our investments. And for simplicity, I've broken our investments into three main areas. The first is cash. We have cash on hand. We need some cash to pay bills, so we like to have some cash on hand. And then secondly, non-cash items. There might be some assets in terms of buildings, vehicles, etc. But we talk a lot to commercial contracting businesses, commercial flooring businesses, and the bulk of their investment is made in something we call working capital. It simply means the money we need to make our business work in order to operate. And it breaks down into three main categories. Accounts receivable. That's where we've done the work and we've invoiced our customer. But the customer actually hasn't given us the money for that work. We're still waiting to receive that money. So it's our money, but it happens to be in our customer's pocket at this time. So it's money that's not in our business right now. Secondly, we have to invest in inventory, and also within contracting businesses, we have a lot of working capital around underbillings. In other words, we've done a lot of work, but we haven't necessarily billed for that work. So we've done the work, we're owed the money, but we haven't actually sent an invoice to the customer. And lastly, there's the money that we owe our suppliers for our materials, etc. And so the total working capital dollars is our accounts receivable plus our inventory less our accounts payable. So that's what working capital is. So now that we know how all of that fits together, I can show you how vanity, sanity, and the king operate. You remember, vanity makes our sales, sanity watches price and cost to optimize our margins, and coming out the bottom of the money-making machine is retained earnings, which is rocket fuel for our wealth creation engine. Because if you remember, I said there are two places we can get money from, our own money or other people's money. So if your business is working well and you're making a lot of profit and that drops down to the bottom of the money-making machine as retained earnings, we can put more equity into the business. So this builds up, which means we could reduce our debt, for example. And also, if we squeeze our working capital, in other words, we manage our receivables and we manage our inventory and underbillings and keep that less, then we're going to need less debt and less funding to operate our business. So we want this to be as small small as possible, and we want this to be as big as possible, so we're not paying interest on that. And the king, our friend the king, is watching that cash. All right, so he's managing the cash, which is allowing the business to make investments, maybe to hire more salespeople, maybe to do more marketing, maybe to make more products, so we can make more sales. So vanity makes more sales. Sanity watches the prices and costs. We make more money in our money-making machine. We stick that more retained earnings. We keep some for ourselves. We distribute some of that money to the owners, but more of it goes into the wealth creation engine. And if we run this in a lean fashion, we have this business cycle that generates more sales, more revenues with a leaner balance sheet, which allows the king to have much more cash. So that's simply how a simple explanation of the balance sheet in terms of the wealth creation engine. Hope you found that useful.